Hey Hector, it's Brian over at Showcase Agency. Just want to say, first of all, thanks for filling out the quiz. I really appreciate that. I'm going to show you some options that I put together for you based on the answers that you gave us on your quiz. So let's run through the quiz real quick. So you said you're a first-time home buyer. We'll take a look at some of those options. That does open you up to a 3% down option. I know later on in the quiz we'll see that you put down more money, but first-time buyer, you do get a 3% option. Are you eligible for VA? You said no. Let me hit on this real quick. Los Angeles County, LA County, there's a loan limit of $822,375. That's for conforming and FHA. You mentioned you're also interested in San Bernardino. San Bernardino is a little different. There's a different number for conforming and there's a different number for FHA. $548,250 is our maximum loan amount over in San Bernardino for conforming. That's also called a Fannie Mae loan or a Freddie Mac loan. And then the $477,250 that you see, that's for FHA. So that's our max amount for FHA. I'm going to show you conventional options, not FHA options, but I'm just letting you know what the loan limits are. Your annual income's above $68,800. No student loans. You're looking for a single family, primary residence. Not sure how long you keep the home. In a situation like that, I'd go ahead and go with a fixed rate, not an adjustable rate. How much are you thinking of spending? You put down $2,800 a month. That's going to work out to be about $540 to $580 in purchase price. You said you got 15% down payment and excellent credit. If you got 15% down payment and excellent credit, we're definitely going to look at conforming loans, and I mentioned before, also called Fannie or Freddie. So let's hop over here. Let me show you what loan options I put together for you. All right, Hector, so I put together some conforming loan options for you. Like I mentioned before, they're also called Fannie or Freddie, sometimes called conventional. These are all 30-year terms, are all fixed rates. Two of the options are going to be with a 15% down payment, so that's 85% loan to value. And then two options are going to be at 90% loan to value. I also put together options where you have a cost for the rate, and what that means is that the rate is lower because you're paying upfront an upfront fee to buy down the rate. I'm also going to show you options with a credit, and that's where the interest rate's higher and you're getting a credit back that goes towards your closing cost. So I hope this makes sense. I'm going to show you some numbers. Let's jump over to those right now. All right, Hector, let's take a look at the loan options we put together for you. There's 4 options, but before we do that real quick, this little box, the little menu tab, you can switch the view. So I'm going to do that real quick. And what you want to look for is the summary box. And I sent you a quote to this, and there's also a link to this in the description in YouTube as well for the video. So you can click on this and you can dig into this. I'm going to show you what to look for in different things. But look for the summary box. It's got your 4 loan options side by side. The first one is the conforming with 15% down. And it's the interest rate that has a cost. So that means it's going to have our lowest interest rate, but there's a cost for it. So there's going to be more money out of your pocket because the closing costs are higher. The second option, so that's the first option. The second option that we're going to look at is also 15% down, but this one is going to have, and it's at $580,000 purchase price. Both of these are $580,000. But this one is going to have a credit to it. So the interest rate's higher, but it's going to be less money out of pocket. These options here are at $540,000, the last 2 options, $540,000 purchase price, and they're with 10% down. This one's at a cost, so again, lower interest rate, a little bit more money out of pocket, and then this one's going to have a higher interest rate and less money out of pocket. So these are the options that we've got. Let's take a look at them in detail, and then you can dig into this in even more detail, whatever you like. The first option, 30-year fixed, 85% LTV. It's a $580,000 purchase price. That gives us a $493,000 loan amount, 2.625 rate. The APR on this is 2.795. A lot of times people say, Brian, what's the difference between the interest rate and the APR? The interest rate's the interest rate on the loan. The APR takes into account the interest rate and then also your closing cost over time, over the life of the loan. So 2.795 is your APR, 30-year term. And then we're estimating the payment on this to be $2,734. So there's your payment. And if you click on the more info button right here, you can see a breakdown of the payment. So here's our payment. You can see $53 goes to mortgage insurance, $96 is going towards your homeowner's insurance, also called hazard, and then $604 is going to your property tax. So out of that $2,734 payment, only $1,980 is actually going to cover the loan itself. But you can see the breakdown of all the payments, and there's also a box here for closing costs. So these are the points I was talking about, $5,211. Those are the points. And then if you wanted to see breakdown of the fees, here's the fees. And then there's also what's called reserves. Whoops. Reserves right here. And this is to set up an account so that when your taxes come due, you're not having to pay that out of your own pocket. You've kind of budgeted for it, so it's included into the payment, and the mortgage company would make that payment for you, the property tax payment. So let's hop back to this. How much money does it take? It takes about 102 grand. That's your down payment of 15% plus whatever closing costs you got. And remember, our closing costs are higher on this one because we've got $5,000 or so in points that we just saw. All right, so that's your first option. Your second option is basically the same thing, but what we did is we just increased the rate. So we increased the rate to 3.19, and then that made the payment go up. But what happened, it went up to $2,883. But then our cash to close went down like $11,000. Now we're at $91,000. So if you'd rather have a little bit higher payment and keep more money in the bank, this would be a good option for you. I've also put together some options at 10% down. This one's a $540,000 purchase price. 10% down is $486. Interest rate's 2.625. APR is 2.88. And what does this give us in a payment? About $2,721. Again, if you want to see a breakdown, you just go to more info, and it's going to be right there. And what's your money out of pocket? $68,000. So it's a big difference to go from 15% down to 10% down. And let's look at this last one. Also $540 purchase price. We did the same thing that we did on the other on the 10% down options. We bumped up the rate to 3.19. That increases the APR to 3.279. But the cash to close goes way down. So your payment goes to $28.69. Your cash out of pocket drops to $58,000. So this just gives you an idea of how the interest rate can affect the amount of money that you have out of pocket. So hopefully you'll get a chance to kind of dig around on here and look at the closing costs, look at the differences in the payments, the things like that. If you've got any questions, just text me. Happy to answer them. This is a chart that just shows the difference in the monthly payment. Honestly, it's not that helpful on this type of program, but it's really good on some programs like refinances, things like that. This chart, though, actually is good. If you were, and then I'm going to click on this button to show you why. So what this chart does is it shows you your cost for the loans over the first 60 months, so the first 5 years. And so if you were comparing the two different 15% down loans, you could look in here and you could see that this one's going to cost you $73,000 over 5 years, and this one's going to cost you $76,000 over 5 years. So there's a $3,000 difference here. Not a huge difference over 5 years. It could mean a lot to you, or it may not. It may not be that big a deal to save $3,000 over, the first 60 months. You might had rather keep $10,000 in your pocket because you went with a higher interest rate and didn't pay points. So this is a good analysis. You can take a look at that. Again, if you have questions, just let me know. And this is one I love to show people, especially if you're buying your first home. Real estate is a fast way to supercharge your net worth. So this is what buying this piece of property would do to your net worth in just 5 years. Basically, it would add $250,000 to your financial net worth, which is the difference between what you owe on things and the value of those things. And so in 5 years, this estimates that you'd have anywhere from like $223,000 in equity. That's the difference between what the house is worth and what you owe. And maybe as high as $270,000. Could be more. You never know. But this takes into account a 4% appreciation every year. So it's very conservative. All right, I hope you found that helpful. Let's take a look at what it takes to qualify for this type of loan. All right, Hector, this is a conforming loan like we talked about before. It could be called conventional or Fannie or Freddie. it has a 50% maximum debt to income ratio. So what does that mean? It just means if we take your mortgage payment, the proposed mortgage payment, and we add that to all of your minimum monthly payments that show up on a credit report. So like car loan, car lease, credit card, installment loan, things like that. If we add all of those things to the proposed mortgage payment, and then we divide that by your gross income, your income before taxes and deductions, we got to stay within 50%. So the first column shows zero debt. If you had zero debt, we'd need about $67,200 a year in income for you to qualify for these loans that I just showed you, or qualify for a $2,800 payment. The middle column, $500 a month in debt. If you had $500 a month in debt, you'd need $79,200. And then if you had $1,000 a month in debt, you need about $91,200 to qualify for this particular loan. Earlier I mentioned county limits. Let me tell you a little bit about that. So like I mentioned before, every county has a different, potentially could have a different loan limit. And then sometimes the Fannie Mae, Freddie Mac limits are different from the FHA limit. So if you want to check this out, and also too, if you buy a 2-unit or a 3-unit or a 4-unit home, like a quadplex or a triplex or whatever, the loan limits go up. So if you want to check this out for yourself, I put these links in the description on YouTube. And then also too, if you're ready to buy and you want us to show you a home, just text us the address. If you want to get pre-approved, you can get pre-approved. There's the link for that. If you're not that far along yet, you're just gathering information, visit our site. We're constantly putting more content there. If you have questions, we're happy to help. You can text or call our office. And if you'd like to schedule a discovery call where you can talk with one of our experts about your real estate questions, your home loan questions, where you're trying to go with this, what you're trying to accomplish, then you can do that all. You can just schedule with that link right there. So thank you so much, Hector. I really appreciate it. Thanks for filling this out. I hope you found it helpful, and please reach out. Let me know if you got questions. That's what we're here for. All right, thanks. Have an awesome day.